Quantitative easing, QE, is a form of monetary policy in which a central bank purchases securities from the open market. This creates new bank reserves, providing banks with more liquidity and encouraging lending and investment. The idea is that this will reduce interest rates and stimulate lending and investment. But QE isn't a one-size-fits-all solution. While it can be a boon to borrowers and investors, it carries risks, such as inflation and currency devaluation. Remember, more money in circulation can decrease the value of that money. Can QE really spur economic growth? Critics fear potential side effects like stagflation and a credit crunch, warning of the risk of hyperinflation. On the other hand, proponents praise QE for increasing liquidity and promoting lending. So, is QE a hero or a villain in our economic tale? It's all a matter of perspective. Different countries have employed QE with varying degrees of success. Like any tool, its effectiveness depends on how it's used. And in the world of economics, nothing is ever quite as simple as it seems.